Hello and welcome back to another Crypto Club podcast. This is Gons. Of course, we also have Hobo. Say hello, Hobo.
Hello.
Right on. Another excellent Friday. We got some great stories to talk about today.
As always. Yep. Another week of slums in the markets. Uh, the latter half of this week, we saw the stock market kind of turning around from a lower low, probably up about 3 to 5% in most of the ETFs and larger funds. But despite that, we've still seen crypto falling, which is kind of peculiar. A big argument for Bitcoin being a security has been that it's following the trends of the greater stock market. Um, and this week that's been true in the unfortunate direction, of course. Right here on the Yahoo Finance, we can see, Russell 2000 up 2.5% today, Nasdaq up 3.5%. So stock markets look pretty good. Crypto not looking so good. So getting into this first story here, we're talking about Bitcoin breaks from stocks and keeps on falling as crypto slides.
Slide to the left.
Right, slide to the down.
Slide all the way down.
yeah, yeah, yeah. So,
So, I'll say this. I like it. And the reason I like it is crypto and Bitcoin never really should have been mirroring the stock market
yeah,
in the first place. So if it takes like a great reset, which is, and again, I've said it in a few other podcasts, like investor mindset is in a horrible place in crypto. Like, again, fundamentals were abandoned. There were a lot of exploits, like very, very low quality developers rushing out cheap products that
right.
were getting hacked. I mean, this was inevitable. So if this is what it takes to then purge the ecosystem of all the bad actors, all the lazy investors,
Mm-hmm.
and get us to a new all-time high, I'm all for it. And if in the process of that great reset, we also see crypto, not just Bitcoin, but crypto in general, become its own separate sector with its own separate patterns and trends
Right.
that deviate from the stock market, I will be so happy. So happy.
Yeah. Yeah. No. I agree with you. Um, Bitcoin was never, or I guess the crypto market in general, was never meant to follow the trends of the stocks, but it's become so widely adopted that it's naturally going to reflect the greater outlook on the economy. But it
It
is
should
not.
have it should have always followed the opposite of stocks in my opinion because I mean it's a deflationary asset that is supposed to appreciate in price and at the same time it's decentralized so it shouldn't be moved or swayed by any outside influence or organizations or companies or
Well,
world events to an extent, right?
yeah,
So I think there's just been too much influence on crypto. And so I'm actually happy one way or another that it's moving in any other direction on its own, whether
mm,
that's up or down.
yeah. No, I would agree. But crypto is obviously the majority of people see it as a risk on asset. I think
Yep.
it's too early in its market structure to really um, say otherwise, and so I would agree with it being a risk on asset. And surely the economy doesn't look great. A lot of people are getting out of risky assets, moving to safer ones, and so I think that has to do with a big reason of why we're still seeing it slump down while the greater markets are kind of having a relief rally. But let's dig into the article here a little bit. So it says Bitcoin led a decline in digital assets across the whole crypto spectrum, with the world's largest token set for an eighth straight weekly loss and its longest slump since August 2011. Bitcoin fell 2.4% on Friday to about $28,700 as of 5 p.m. in New York, buffeted by both the macro headwinds by the Federal Reserve monetary tightening and the crypto-specific fallout from this month's implosion of the Terra USD algorithmic stablecoin, which continues to weigh on digital assets, particularly those related to decentralized finance. Although the crypto market has lost some $500 billion in market value so far in May, a 29% plunge for a second day, cryptocurrencies declined even as risk assets such as stocks rose, making a break from the recent lockstep relationship, and a sign of a shaky conviction that could portend a worrisome trend. The market swoon took a lot of confidence out of the asset class, Matt Maley, chief market strategist at Miller Tabak, said by email. Therefore, as investors become a little more confident about the markets in general, they're looking at other areas in which to buy on weakness. They don't want to get burned again in cryptos. I think that is a fair hawkish outlook on it. Really, the markets are taking a downturn. You want to look for signs of strength. Even in crypto markets, like when Bitcoin crashes 10-15%, there's going to be altcoins that crash 50%, and then there's going to be altcoins that crash 10 to 15%. And really looking for those signs of strength is a good thing to keep your eye on. And so in the broader view of markets and looking for signs of strength in crypto versus the stock market per se, it's not looking great, but at the same time it's kind of a different concept and is applied in the more niche aspects of crypto. So we'll just see what happens.
Yep. It's I agree. It's understandable, and investor sentiment is pretty much at an all-time fear level from what I was reading the other day. So
yeah,
I don't blame anybody, and again, I think it's just a necessary step in the larger picture of things.
Right. So, getting on with the article here, it says Ether, the second largest cryptocurrency, and other altcoins linked to popular DeFi projects like Avalanche and Solana were among the biggest decliners, down between 4 and 6% on Friday. And in the market for non-fungible tokens, even popular collections like Bored Ape Yacht Club and CryptoPunks are coming under pressure, market data shows. Meanwhile, short interest in the first U.S. Bitcoin futures-backed exchange-traded fund is near the highest since the fund's October 2021 inception, as investors step up bearish bets. With the reverberations from Terra's collapse hitting altcoins harder, Bitcoin now claims the largest share of the cryptosphere, accounting for 44% of the total market's value. That's the most since October, just before the latest bull market peaked, based on data from CoinGecko. But it's not as if Bitcoin has been spared. It is now down almost 60% from its all-time high in November, though it has generally traded in a range of 28,000 to 30,000 in the past couple of weeks. The biggest cryptocurrency remains below its 20, 50, and 200-day moving averages, with each moving average currently sloping lower. It's the epitome of a downtrend, Frank Capillari, a trading desk strategist at Instinet, said. There's no question that the strong correlation between cryptocurrencies and other risk assets has broke down recently, as tech stocks in the U.S. rally after weeks in the doldrums. Digital assets have largely stayed in the sidelines. Fiona Sensata, senior market analyst at City Index, said by email, "This is far from the decoupling that Bitcoin bulls were looking for." Sensata said, "I doubt this will be the end of the Bitcoin-Nasdaq positive correlation. However, the concern is Bitcoin may only trace the Nasdaq when it falls. A move below 28,000 would be significant to continue the downtrend and test the year's $25,425 low." Sensata said, "Beyond this, 20,000 is the next psychological level that comes into play. On the flip side, buyers will be looking for a move over 31,500 for a breakout to the upside and for any chance of a recovery in the price," she added. So yeah, throughout crypto's history, throughout crypto's history, the current bull trend has never dropped below the previous bull trend, or even in the bear trend after the most recent bull trend, has never dropped below the previous cycle's bull trend. And the previous cycle's bull trend peaked out at just below $20,000. So I mean, really, I don't see us going below $20,000. Although, you know, history doesn't repeat itself, but it rhymes. That's what I'm placing my bets on.
Yeah, I mean, you're absolutely right. It's always done that in the past. However, in the past, I don't think there was nearly the amount of eyes or volume on it.
Yeah.
And I don't think in the past we've ever had this level of issues in the macroeconomics side
Yeah.
of things. So it's curious to see what happens. I think we're probably safe as far as you know what you said. I don't think we will break below the previous bull trend, but we will certainly test it.
Right.
I definitely think we will test it.
Yep. And of course, it goes without saying, none of this is financial advice, and we are just simply
Although I'm gonna
sharing
ape
our.
life savings at 20K. Thank you.
Yep.
No, but yeah, obviously do your own research. We're just, sharing our thoughts and ideas here. None of this is financial advice or anything, but yeah, I mean, I'm curious to see what happens. I think overall everybody should be pretty optimistic, long term. The reality is long-term investments like this, it doesn't really matter what happens, every 6 months. It's more like what happens year over year. So
Right.
I think overall crypto is going to be a pretty positive growth year over year over time.
Mm-hmm.
We may have a slight bear trend the next, this year and possibly next, or we may bounce back off 20 and go into a bull run. Who knows? But I think overall the space is optimistic in the future. I just think right now we have to purge the whole system of, like I said, all the bad actors, all the greedy and misconceptions and bad mindsets and bad investing practices.
Yeah, I would agree. I'm just popping open Trading View for a second here. So, I mean, we can see previous cycles bull run peaking out at roughly 19,800, something like that. So, really, I don't see us breaking below that, as we never have in the past. But, like you said, there's a lot more eyes on it, and we are facing some quite turbulent economic conditions that we haven't really seen since crypto's inception. But I mean, you look at some of the alts that just absolutely blew up this year. Like, let's take a look at Solana, for example. Let's see. I mean, Solana is just down massively. I mean, I'm looking at the Solana tether pair on KuCoin. So it looks like they listed Solana when it was just about $38, and it's just back to KuCoin's listing price of, or almost
No
there.
way.
It's at $41 right now, but
Whoa.
yeah, dude, peaked
Oh
at
my God.
250.
Man,
So
I
I
have
mean,
such a love-hate relationship with Solana.
mm,
I'll never forget I had bought Solana at like $55
mm-hmm.
because I wanted to mint. What are they? The apes on Solana?
Probably Soul Apes or something like that.
No, 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 the big one, the huge one. The degen apes. Is that what it's called?
I really don't know.
It's huge. It went. Well, anyway, I was trying to ape it. It was Degen Ape Academy. I just looked it up.
Mm,
And they peaked like over 100 SOL per mint,
yeah.
and mint was like 2 or 3 SOL.
Mm,
And so I had purchased SOL at like $55 because I was gonna mint like 4 or 5 of these.
yeah.
And long story short, from what I remember, is like I think they delayed the launch or they had like a glitch in the website and you couldn't mint. And I was like, man, Sol is dumb. I'm going back to ETH. And I sold all my Sol
Yeah.
and
You sold your
never got
soul.
to mint them. And that was a huge fumble. Huge fumble.
R.I.P.
Never forget it.
That's what happens when you sell your soul, my friend.
I sold my soul.
Tragic. Yeah, I mean, we could take a look at ADA as well. ADA is down bad. 45 cents, dude.
Oh yeah, Ada was like crazy.
Oh,
I
man.
never touched Ada, but
Yeah, me
that was
neither.
a crazy story.
ADA had so many fanboys, and I mean, I don't know. My take on ADA has always been, I've watched a couple podcasts with Charles Hodkinson, the developer CEO of ADA, and I just don't like the dude. Like, I don't know what it is about him. He's just kind of cocky and arrogant, and I just don't like the dude, so I never bought ADA.
Hmm. Seems like that's a trend. When you have those
Right.
kind of developers, you need to short their coins.
Yeah, that's very true. Oh, just ridiculous, though. I mean, it's
Nick?
less than half of what Coinbase listed it at, so
Yeah, I mean, obviously we've seen like massive corrections, but I've said it time and time again. Any asset class that can give you 2 to 3 to 10x returns, you need to expect, you know, 50 to 90% drops
yeah,
on the way down as well, because that's just how it works.
yeah, no,
So,
this is very true. I mean, also like it's interesting because like ADA, I don't think they still have a working product. I believe there's like a layer 2 built on ADA that's working, the Milky ADA.
yeah, I've heard of it. I haven't used it or touched it or really looked into it, so I won't comment too much because I'm pretty ignorant on their, on Milky Ada or
Yeah,
whatever it's called. But I mean, I think it's working from what I've seen. So,
yeah. Let's see, does this have the market cap on here? Does not. I always love how TradingView always tells you it's a strong sell, like after it's fallen, what, 80%, something like that.
hmm.
But yeah. So I mean, altcoins decimated. ETH is hanging in there relatively. We're resting right here on that 1700 support that we visited in
Ooh.
2021 a handful of times.
So I think just to stray away from the article for a second, I think, right, long term, Ethereum definitely should outperform Bitcoin just
Yeah,
because of the utility and the use case. Um, but it will take the market being overhauled and appreciating utility
mm-hmm.
to get ETH to that level, right? Um, in the meantime, you're just going to see Bitcoin dominance continue to grow during a
Right.
bear market, which has always been the case. And that's what's happening. So Bitcoin is holding up really well compared to everything else. And so everything drops pretty heavily whenever Bitcoin starts to go down.
Right. Yeah. Fun times in the crypto market.
Let's move on to this next article because I think I might mention it briefly there about the Bitcoin dominance.
Yeah, let's do it.
No,
So,
definitely. It's Bitcoin on track to extend a record losing streak.
yep. So, digging into the article here, it says Bitcoin has lost ground for 8 consecutive weeks for the first time in history and will extend its losing streak if it doesn't reclaim $30,300 in the next 3 days. Ether is trading at the lowest level relative to Bitcoin in 7 months. Assigned traders may be flocking to so-called digital gold and away from the world computer. The ETH/Bitcoin ratio is at 0.061, the lowest since October, as ETH has slumped 37% in the last 30 days compared with Bitcoin's 23% slide. ETH is trading at 1760, its lowest level since July 2021, while Bitcoin is trading at 29,000. Real quick, I just want to mention, I know we've talked about it before, but like the whole like Kramer calling out things, and like inversely trading Kramer. I remember it was probably 2 or 3 weeks ago. Kramer was calling for a 20% rise in ETH. And
You did. I remember
yeah,
that.
yeah. What do you know? We have fallen 37% in the last 30 days. So,
Listen to Hobo's financial advice.
let's not call it that. Just don't listen to Kramer's financial advice.
So
That's really all you have
I
to
think
do.
I think the previous consecutive red weekly candles streak was 6, if I'm not mistaken. So we are at 8 now. Yeah, are we closing in on 8 or
Yeah,
is it
yeah.
9?
No, we're closing in on 8.
Yeah, and the previous record was 6. So we've been going downhill for 8 weeks now. It's crazy.
Yep, feels bad, man. But here's a little piece about the dominance. So this is Bitcoin's percentage of the overall cryptocurrency market, also known as Bitcoin dominance, is ticking up above 40% after dipping to 39% for the first time since 2018. Crypto has been trading in lockstep with equity markets for the past few quarters. However, today was an exception. While the Nasdaq surged 3%, Ether sank over 7%, with most altcoins faring worse. Bitcoin was relatively unscathed, down 1% on the day.
Yeah, see, that's a huge difference right there. So I expect until we hit that bottom and then everything starts rallying back up, I think Bitcoin is gonna assert its dominance over the market and probably, like I said, ETH will probably do better than most altcoins. From the reports I've been hearing, most of the like real altcoins are down like 10+%
Mm-hmm.
versus ETH 7 and Bitcoin's 1. So
Right.
overall, ETH is still doing pretty good, but that's still a massive difference.
For sure. Yeah. Yep. So we got the worst performance right here. Move to earn NFT sensation Step N was today's worst performer, down 36% in one day. Um, and then Avalanche lost 17% in one day, down at $23. Wow.
Oof, look at ApeCoin,
I know.
$6. So yeah, I mean, ETH is doing really well in comparison, especially when you look at some of these altcoins that are down, like again, anywhere from 10 to 36% in a
Right.
day. Insane.
Yeah. Pretty intense. But that about sums up that article. Kind of just building off of
Yeah.
the previous article. Um, let's head on to the next one here. So we're in a bear market, and I think that's good. Crypto firms hope market slump shakes out bad players. This is something
I
constantly,
agree.
we briefly just talked about. Um, I also agree. I think that there always needs to be a cleanse, and it's just part of the equilibrium in all markets. In the .com bubble, you had companies raising millions effortlessly with nothing but a concept. There are plenty of cases of investors being defrauded, companies never delivering anything. It's a very similar phenomenon that we're seeing. But, if you look at the stock market today, most of the top 10 stocks are technology companies. And I think it's a similar concept that we'll see with crypto. We're just going through the growing pains right now. But executives from the blockchain and cryptocurrency industry told CNBC that the recent crash in the digital coin market should help get rid of bad actors in the space. Billions of dollars of value has been wiped off the cryptocurrency market in the last few weeks, driven by a sell-off in stocks and the collapse of algorithmic stablecoin Terra USD. We're in a bear market, and I think that's good. It's good because it's going to clear the people who were there for bad reasons. Bertrand Perez, CEO of the Web3 Foundation, told CNBC at the World Economic Forum in Davos, Switzerland. At the World Economic Forum. Very nice. He also says, it's good also because all of those projects are gone, so the legit ones will be able to focus only on developing, on building, and forget about the valuation of the token because everyone is down. During the bull markets, when everything is green, no one thinks about building. Everyone thinks about making a fortune, which is the wrong mindset, he added. So,
Preach.
yeah, no, very true. I know that at CoinScan, it's nice to just be able to really build. It's kind of just what we've been doing the whole time, but there's a lot less the forest isn't on fire around us, like it's kind of the ash is settling and we're just,
Yeah, kind of touching on that subject with CoinScan. It's one of those things like real projects and real developers love this time period because they get to build almost in a relaxed state,
yeah.
right? Whereas in like a bull market, it's like rush, 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 get it out, get it out, get it out.
Mm-hmm.
Versus now we can take our time, perfect everything. There's no real reason to rush it to production
Right.
because we're in a bear market. You know, there's no real point to releasing it, until we either hit the bottom or we're back in a good bull market.
Mm-hmm.
So at that point, the real developers are still grinding it out every day working, and it's very easy. A lot of investors, and again, this is why it's so famously quoted all the time. Fortunes are made in bear markets because the smart investor will find these projects and these developers that are utilizing this time correctly and properly to build and strategize so that when the next bull market comes, these are the projects that explode and they come
Right.
out of no versus most of the lazy developers or the pump and dumpers. They take vacations around this time and like I'm talking months of vacation. They don't
Yeah.
even come back until October.
Yep. Yep.
Um, they take vacations, they go MIA, they abandon the projects. They're like, why am I going to work on this project if my chart isn't pumping? So that's the wrong mindset. And again, I 100% agree with this guy. It's the wrong mindset in crypto
Mm-hmm.
right now. So purge it all. Let 90% of these coins go to zero, honestly. And from there, we can build back up and really move forward.
The Build Back Better plan.
And that's exactly what we're doing at CoinScan. I mean, we are working every day, and it's a lot less stressful now too with the bear market. I mean, I think most of our community understands that there's no real rush, and
Yeah.
it's better to perfect everything now before we release, the main net, you know, and yeah, just take our time and do it right the first time. There's no
Mm-hmm.
better way.
100%. It's yeah. Me Mihailo Vjelic. Um, I don't know how you say that name. It's right here. You can take a look. Co- Co-founder of blockchain company Polygon echoed the sentiment, calling the cryptocurrency sell-off necessary. The market, in my personal opinion, became maybe a little bit irrational or maybe a little reckless to a certain extent. And when the times like that come, a correction is normally needed. And at the end of the day, is healthy. The sell-off of major digital currencies such as Bitcoin and Ether was sparked by a broader slump in stock markets. In particular, the technology sector. The drop was worsened by the Terra USD stablecoin losing its peg. Yada, yada, yada. If people are looking for assets to sell, crypto is going to be on the list, Harrison told CNBC. Um, yeah, and then we got Brad Garlinghouse, the CEO of Ripple, urging investors to take a longer term view. So, Bitcoin about 2 years ago, right now, Bitcoin was about $8,000. Now it's at $30,000. So, yes, there's been a crash and $1 trillion came off. But when you zoom out a little bit further and look at the long term trends, I think you see that crypto is here to stay. And
Absolutely.
yeah, that is very true. Just bringing it, just going to go ahead and pull up the logarithmic chart on TradingView quickly because,
Oh, look at you.
man, the logarithmic chart, like, it goes all the way back to 2012 and it just follows ever since the inception, like, just follows quite the trend. And you can just see its steady upward trajectory. Who knows? Maybe crypto goes to zero. I sure hope not. But yeah, I believe crypto's here to stay, and we're just feeling the pains along with the rest of the market. But that about sums up that article, so we'll head on to the next one here. talking about Ethereum miner tries to expedite testnet merge by 2 weeks. So, unless you've been living under a rock, if you're interested in crypto, you've heard about the so-called ETH merge that's supposed to come in fall of 2022. So it says Ethereum developers foiled a mischievous miner's attempt to expedite Ethereum's transaction to proof of stake on a public testnet by 2 weeks. Developers expect Ethereum's ETH2 beacon chain to merge with Ethereum's mainnet this autumn. The transition, known as the merge, will change the chain to proof of stake consensus and abandon proof of work miners. Ethereum's developers want to trial the merge on public testnets first and have chosen Ropsten as their initial target. To do so, they coded a difficulty bomb into Ethereum and its testnets. When it explodes, mining will become so difficult that the network will be compelled to transition to proof of stake. The Ropsten bomb explodes at a specific block height, which the devs calculated would be on June 8th. But on May 26th, Twitter flooded with posts flagging that the Ropsten merge was suddenly on track to go live on May 27th, 13 days ahead of schedule, and 3 days before the beacon chain was scheduled to launch on Ropsten. Ethereum core dev Preston Van Loon attributed the sudden change in schedule to a 100x increase in hashing power on Ropsten between May 25th and May 26th. The spike in hash rate sped up the production of the blocks, meaning miners were predicted to trigger the difficulty bomb far sooner. Bed Eddington, the founder of ETH2 client Teku, blamed the spike in hash rate on a mischievous miner. Another core dev, Tim Bako, chalked the incident up to low hash rates on Ethereum's testnets. Devs foiled the errant miner by delaying the difficulty bomb to a later block height. The only consequence is that validators who have already downloaded an update to the Ropsten merge client will have to upgrade again. Core developer Marius van der Wijden.
Yeah.
There's a error in this article. It should say says right here, I assume. Anyways, core developer Marius van der Wijden says that this couldn't happen on Ethereum's mainnet because it would be too expensive for a miner to sharply increase Ethereum's hash rate.
Oh, for sure. It would take so much to do that.
Mm-hmm.
But on testnet, not so much. It makes sense. Fun fact, I did not know that it was scheduled for June 8th. I've been pretty out of the loop. So
yeah, well, I mean that's the testnet, not the actual merge,
Yeah, the merge they said is later on in the fall, right?
Yeah.
What'd they say? Do you remember? Is it like October, I think?
Yeah, it just says autumn in this article.
Autumn, yeah. Well, see, even Vitalik is doing that. He left to go on a month-long vacation. He'll be back in October.
I think,
and then bull run.
I think it's interesting that there's a discrepancy among those top two lead developers on what exactly caused it. Either they miscalculated because they were using the hash rate of the ETH mainnet and not the testnet, or perhaps it was a mischievous miner. But
I don't think they accounted for a mischievous miner going to that lengths on testnet to do that. It makes sense, to be honest. But what do you think once we do basically hit ETH 2.0 and we merge? What is your outlook as far as how that will benefit Ethereum, and whether that'll have like a... Do you think that it will also push Ethereum to finally surpass Bitcoin as well?
Honestly, I don't really know enough about the mechanics of what exactly is going to be changing to make a solid point on that.
Keep in mind that when we do transition to proof of stake, it will not necessarily reduce gas. So gas fees are still going to be, relatively expensive on Ethereum.
Yeah.
And they'll be based as far as like network usage. So I don't think it'll do much for the gas issue. So there is still a place there for a competitor to, basically overtake Ethereum in the future with cheaper gas fees. I
Right.
mean, we already see that with BNB, Solana, all these other, EVM forks.
Yeah.
So even though this is a good solution for Ethereum, I don't think it's a permanent solution. And I don't think it solves one of the biggest issues with Ethereum, which is gas fees. So ultimately, it's a huge improvement for the network, but I don't think it'll cement it into forever becoming like the holy blockchain.
Right.
I think it will push Ethereum up as long as everything works well and there are improvements in the network. Um, Maybe, possibly, I think it'll definitely bridge the gap between Bitcoin and Ethereum. I don't know if it'll surpass it just because of this, but we should definitely see an improvement if everything works well and they don't delay it. There's a lot of talks actually. I was reading on it today and listening to forget the guy's name, but I was also listening to like a reputable guy's podcast on this,
Mm-hmm.
and he was saying that he wouldn't be surprised if you know we roll around to late summer and then they start announcing that they're going to delay it into 2023 or
Yeah.
as ETH 2.0. So
Right.
if
And,
they
I
keep
mean, that's,
delaying it could also really hurt Ethereum.
yeah, I don't know. I think Ethereum's too prevalent just with all the technology already on it for it to really be hurt that bad, I mean, it's already been delayed a handful of times. I remember it was supposed to be coming out in June, then he said autumn, and we'll see what he says next.
Well, yes and no. It's not going to kill Ethereum if they delay it, but you have to understand that with so many delays constantly, I mean, if you're an Ethereum maxi, like ETH 2.0 is your saving grace. Like that's what you're banking on,
Right.
um, per se. So if that keeps getting delayed, investor sentiment is not going to withstand, another year or another 6 months. In my opinion, it would definitely hurt Ethereum, as far as their market capitulation. But I mean, we'll see. We'll see what happens. Hopefully, they don't slack off over the next few months,
Yeah.
and they deliver. That's that's the whole point of the space. Find
Yeah.
yourself good devs that can deliver, and
Vitalik's going to lose his private keys.
you will do very well.
Yeah, but that about wraps up that story. So right here we're talking about Ethereum founder Vitalik Buterin defends Algo
Speak of the
stables.
devil.
Yeah. So Ethereum investor and founder Vitalik said that algorithmic stablecoins should be scrutinized according to how they fare under extreme market conditions and whether they can safely wind down when the hype falls away. Despite the recent collapse of UST and Luna, which knocked UST from its $1 peg, Buterin argued that in an essay on May 25th that automated stablecoins can make sense while criticizing the exorbitant returns offered by those doomed to collapse eventually. UST's meltdown, which took place earlier this month after traders lost confidence in Luna, the volatile coin that propped UST up instead of the cash reserves that back centralized stablecoins, prompted speculation that algorithmic stablecoins are fundamentally flawed. But some algo stables are robust, Buterin said. Buterin pointed to MakerDAO's stablecoin DAI, which has already survived extreme market conditions. DAI is an over-collateralized stablecoin, meaning that each DAI in circulation was minted against a greater value of collateral in ETH, USDC, wrapped Bitcoin, and 7 other cryptocurrencies. DAI could lose parity with the dollar if all of these coins crashed, which is why it asks for extra collateral. Still, DAI minters can get wiped out in a sudden market crash. That's exactly what happened during the Black Thursday crash of March 2020, when most leading crypto assets shed 50% of their value in less than 2 days. Facing a crisis under collateralization, the Maker protocol printed and sold the platform's governance token, MKR, for DAI to pay off its debts, and added support for the centralized stablecoin USDC to back the creation of DAI. The auction was successful, but MKR fell by 60%. Buterin posted 2 questions that can help answer whether an algorithmic stablecoin is resilient enough to withstand shocks. First, can the stablecoin safely wind down to 0 users? But Buterin said Luna, which he refers to as the volatile coin or Volcoin, increased in value before its collapse because speculators expected more network activity and consequently more transaction fees. When that expectation fell away, the system became extremely fragile. Only a small downward shock to demand for the stablecoin could lead to the targeting mechanism printing lots of Volcoins, which causes the Volcoin to hyperinflate, at which point the stablecoin too loses its value, Buterin said. He said it's unlikely that a slow decrease in Volcoin's expected future fees would lead to a gentle and gradual reduction in the market cap of a Volcoin-backed stablecoin. What's more likely is a rapid drop in interest followed by a bang. I think that is quite evident. By contrast, Buterin said that Reflexor Labs' RAI stablecoin, which is the same as DAI except that it only supports ETH as collateral, can safely wind down. That's because investors hold a leveraged position in ETH rather than RAI's governance token, FLX, eliminating the risk of a feedback loop where reduced confidence in RAI causes demand for lending to also decrease. However, in the unlikely scenario that RAI became the main use for Ethereum, a drop in expected future demand for RAI could crash the price of ETH, risking cascades of liquidation and a messy collapse. I don't think RAI would ever become the main use for Ethereum. I think, but that shows the point that if there was ever a algorithmic stablecoin that became the main use for a blockchain and relied on one token too hard, that it would ultimately likely face the same fate as Luna eventually.
Oh yeah, absolutely.
But it's just interesting reading about all the kind of different methods to algorithmic stablecoins. So second, Buterin asks what would happen if a stablecoin were designed to return a 20% profit to its user each year. There's no genuine investment that can get anywhere close to 20% returns per year. What happens if you try? He said that there are only 2 ways to drive 20% annual returns for a stable token. The first is to charge a negative interest rate on holders to cancel out the growth, undermining its utility as a stable token. The other is to turn the project into a Ponzi scheme, giving holders amazing returns for some time until one day it suddenly collapses with a bang. Yeah. These questions are a start. Even if a stablecoin passes these tests, Buterin cited other risks such as collateralization, code bugs, and governance vulnerability. But steady state and extreme case soundness should always be one of the first things that we check for, he said. Very solid analysis by Vitalik. I think the algorithmic stablecoin market kind of got painted with the whole UST collapse. I think it's good that he's bringing light to the fact that not all of them are so risky. When you're getting a 20% return on a stablecoin, there's probably something a little fishy there.
Absolutely. It's unheard of. So
yeah.
You got to do your research. We actually covered it pretty well in a previous podcast episode. As far as these algorithmic stablecoins, some of them could be legitimate. It really just depends, like he said, not only as far as, is it reasonable that it's not a Ponzi scheme? And also, you need to do your research as far as, what is supporting that stablecoin, or those profits from staking, as well as, governance vulnerabilities, like they said. So all of that is really important. So there are some algorithmic stablecoins that work and are good, but again, if you're being promised a 15, 20, 30, 40% return, that should raise some red flags.
Yeah.
Absolutely.
Yep.
At that point, it just becomes Ponzi scheme.
Yeah, precisely. Vitalik said it himself. But yep. So getting on to the next story here. Crypto industry battles to exempt NFTs, DeFi from tax reporting rules. The OECD is trying to introduce new rules to stop crypto from being used to stash assets out of sight of the taxman. Yeah. So we'll see how this goes. So the crypto industry representatives push back at attempts to make them report details of NFTs and DeFi transactions and retail payments to tax authorities at the meeting of the Organization for Economic Cooperation and Development in Paris on Monday. International tax standard setters want to extend existing bank sector rules to stop foreign Bitcoin holdings from being kept secret from revenue services. And they may end up extending them further than both the existing rules that apply to banking and the money laundering norms currently being applied to crypto by parallel standard setter, the Financial Action Task Force. Coinbase's vice president for tax, Lawrence Zlatkin, told the OECD that its plans set out in a March consultation were overly broad because they just don't look at financial assets used as a means of payment or investment. Zlatkin added that the proposals would merely impose additional burdens on a relatively new and nascent industry. Under existing rules, known as the Common Reporting Standard, whose U.S. equivalent is the Foreign Account Tax Compliance Act, banks are required to identify any account holders who are tax residents abroad and send their details to the appropriate authorities to make sure they aren't evading tax. But the industry has argued that these requirements are a lot harder to meet for NFTs whose price, unlike, say, stocks or gold, isn't known at any given time. They also point out that similar non-digital assets such as paintings aren't included in these existing rules. I think really the case for NFTs here is pretty solid. I think logistically and logically, it should depend on the NFT, because there are some NFT pieces that simply are art, like, for example, I remember early on when NFTs were first starting to get traction, there was some artist who sold an NFT of, like, every single one of his paintings in one NFT, and, it sold for, like, $80 million, if I remember correctly. Really, I don't see how that is any different than a painting, which is excluded from these requirements. But at the same time, there's NFTs that have like a staking utility or some other form of utility where they have massive volume. So I think it would make sense for an NFT like that, but I think it's going to take some research and some very talented teams to come to a solid conclusion.
Yeah, it's going to be super tricky. Super tricky. And then the other thing to consider too, right, is, again, NFTs are an undiscovered utility, because right now the utility that they do provide isn't necessarily the final form per se. One of the utilities that NFTs will probably go the route of that would make sense and would be useful is for authentication purposes, because they're non-fungible. So let's say, for every Rolex that exists in the world, there's an accompanying NFT that gets transferred along with the Rolex. And so you always know that it's a genuine Rolex.
Right.
So, that is a legitimate utility that makes sense and will also, probably get implemented down the road. But at the same time, are you then going to have exchanges basically taxing you or reporting your NFT for you owning that Rolex, and then you're going to get taxed on that Rolex NFT, even though you already bought the Rolex in the real world and paid taxes on it anyway? So it becomes super messy, and I don't know. I don't see a clean way for them to do it currently. It's like you said, it's going to take an extremely talented team to achieve that.
Right. Yeah. go back to what they said earlier. Let's see, Zlatkin added that the proposals would merely impose additional burdens on a relatively new and nascent industry. I think that's really the best case to be made right now. Like, it's just so new that we should just let it grow and deal with such things
and
as
figure
they
it out.
come. Yeah. So
Yeah, because there's no like clear way to do it at
yeah,
all.
yeah, no, there's definitely not.
And then on top of that, what's stopping people from converting their crypto into NFTs, right before the tax season to avoid taxes?
Right, right. Yep. So, what should be reported? Parallel money laundering rules set by the global FATF require crypto wallet holders to carry out identity checks only if a particular crypto asset is intended for payment or as a means of investment. But tax officials worry it might be too difficult to apply that test to the diverse range of crypto assets out there. One alternative would be to only consider those crypto assets from Bitcoin to NFTs that are actively traded on an established market, said Lisa Zarlinga, a partner at law firm Steptoe and Johnson, who spoke on behalf of lobby group, the Chamber of Digital Commerce. That could involve looking at whether the prices being offered and accepted are easily acceptable and published, and would in practice require disclosure for anything traded on a major exchange, such as Kraken or Coinbase, as Zarlinga said. Going further than what is done for traditional banking assets, such as interest and dividends, could be a breach of the principle known as technology neutrality, because it treats digital assets more stringently, Zarlinga added. Just because they're digital doesn't mean they should be included. The OECD appears to think that merely applying existing anti-money laundering rules, which look at how a given asset is used, would put wallet providers in an impossible quandary when deciding whether or not they have to report a transaction. A number of delegates found it a very difficult criterion to apply in practice for binary reporting. The OECD's Philip Kerfs said determining whether, say, a given Bored Ape NFT is kept for investment or for aesthetic appeal would constitute a judgment call. I think that's a very good point, just making that decision on whether something is art or whether it's an investment. Yeah, I don't know. It will be interesting to see how this plays out.
It's way too tricky.
Yeah.
It's gotta be something very simple,
Right.
which it's gotta come down to the fact of if you cash out, then you get taxed. If you don't, then it's treated as like you just having an asset. Like, it's no different than art. If I were to buy a painting and just hang it up on my wall, I'm keeping it indefinitely or at least for a long period of time.
Yeah.
I'm not going to get taxed on the value of the painting. However, if I decide to sell it on some kind of online auction and it sells for $1 million, I'm sure that auction house is going to tax me. So when you cash out should be when you get taxed, and everything aside from that should be up to the user. I mean, ultimately, that's what decentralization is, and that's the whole aspect of managing your money. So I think lawmakers are just really trying to get as much as they can out of the crypto ecosystem,
Yeah.
when in reality, it should just be when you cash out. And
Yeah.
that's, I think it's taking so long because they're really trying to come up with ways to do this, but as we see, there's no clear way to distinguish what's an asset, what's art, what's an investment, what is, a long-term investment. There, and aside from that, all the logistical standpoints of, okay, MetaMask is going to report like billions of transactions
Yeah.
to
And
all
then
the
the
world
IRS is going
leading
to figure that
authorities.
out. Yeah.
No, not even just the IRS, like the entire, every single corporation
Right.
or entity in the world that manages taxes. I mean, MetaMask doesn't have the staff for that, and it, it's just insane. Like, it's very simple.
Mm-hmm.
Tax when cash out, that's it.
Yeah, I don't know. I mean, I get that point of view, but also, that's just treating it so much differently than common securities are treated. I mean, sure, things like Bitcoin, or I don't know, the debate for whether crypto is a security is, still thoroughly discussed. Um, yeah, I mean, only paying taxes on when you cash out sure would be simple, but like logistically, I guess logically applying, similar treatment to just how other commodities and like stocks, for example, are treated. I mean, it's not fair, because like, most people are getting returns on their crypto, but yeah, I mean, I would like to pay tax on just what I cash out. Like, don't get me wrong, but
I mean, there's just no other way to do it, like
yeah,
logistically, feasibly, or reasonably. And ultimately, it's the simple solution to an impossible problem,
mm-hmm,
right? When you try to these kind of barriers and complications, like generally speaking, are only solved by simple solutions because anything more than that, and there's just too many variables and too much complexity to actually solve it. And
yeah,
that applies to most things in life. So again, unless some brilliant mastermind teams organize some kind of way to do this, I don't see it happening.
yeah. So, yep, tax experts such as KPMG have advised extending what are known as the Nexus rules, meaning an exchange legally established in a tax haven that serves European customers but still have to play by European norms. Treasuries, I'm not even going to try and say that. You can see it here on my screen. Even raised the idea of creating blacklists of places with weak crypto rules, analogs to the list of uncooperative tax and money laundering jurisdictions kept by the EU. This idea has some support from the industry players who don't want others getting an unfair advantage. We would endorse broader Nexus rules, Coinbase Zlatkin said. I don't think we would argue for entities migrating to places where there is no reporting and easily do that and circumvent these rules. Zlatkin also endorsed the crypto blacklist idea. We don't want to have entities incorporate or otherwise exist and thumb their noses at this whole process, he said. Lawmakers in the European Union have even proposed getting securities market regulators to issue a list of high-risk crypto companies, which could in practice outlaw doing business with firms in tax havens. But the European Commission, brokering talks to introduce money laundering rules for the sector, has argued that plan could breach international trade laws. So, quite a complex issue, dealing with international laws, international tax. Each nation has their own standards that they're going to go by. I mean,
Yeah, it's impossible to
yeah,
manage. Like, and then even this article, or I mean, not this article. This person was, speaking about blacklisting certain places that don't necessarily favor EU regulations
right,
and tax standards or tax cooperation. But the reality is that there's, hundreds of countries in the world that are not going to blacklist that. So it just becomes a huge mess. I mean, we're already seeing that in the global, macroeconomy side of things where you have these exchanges that have like Binance.us, Binance.com. So you have all these scattered different confusing things to adhere to all these different companies. I mean, we either regulate it internationally, like worldwide, because ultimately when you introduce assets, digital assets, you are trading on a global scale. You are not trading on a country scale.
yeah,
And so either there needs to be a global set of rules and regulations that every single country signs off on and agrees,
right,
or it needs to be extremely simplified to just cashing out is taxed, and everything else, there's no way to regulate it, right? Even the U.S. situation, there's blacklisted websites in the U.S. that people just get around with VPNs and stuff like that. So it doesn't work because it's too messy, because it's a globally traded asset. So either global regulations and global restrictions, or just leave it up to the citizens of the world to
Mm-hmm.
to do with their money as they please. And when they cash out in a certain country, then you get taxed according to that country's laws. There's no other simpler way to do it, in my opinion. It's one of the two.
Yeah. Yep. No, I would agree. And I don't think this is going to be something that we see figured out soon. It's going to take quite a while
Yeah,
for.
and good luck getting all those countries to agree.
Right. Right. Yeah.
Ah,
Very true. Well, that wraps up our last article for Crypto Club episode 6. It's crazy. We're already on episode 6. It's pretty fun doing these weekly. This has been brought to you by the CoinScan team, as always. During these bearish market conditions, it's even harder to make money, and there are even more bad players in crypto. Lots of scam tokens being deployed daily, so really make sure you're staying safe using the CoinScan.com platform. And yeah, make sure to like and subscribe and comment. Feel free to join our Telegram if you'd like to become a part of the community. Yeah, it has been a pleasure.
and we will see you guys next week.
That is correct.